A Fed rate cut has just been announced and two more are likely this year. In India, a massive indirect tax cut, GST cut, goes into effect on Monday. More rate cuts in India too may come. To parse the impact of so many tumultuous changes on Indian markets and macros, the JPMorgan Brain Trust is with me. Sanjay Mookim, the head of India Equity Research, and Sajjid Chinoy, head of Asia Economic Research, JPMorgan. Welcome, guys. What a great time to have your JPMorgan 10th Annual Investor Summit. Such a crucible of changes. Sanjay, therefore, to start with you, September 22nd, your conference day coincides with the GST cut going into effect. So I just wanted to ask you, you all must have parsed the impact by now. Yep. After the Q1 earnings, you may have a forecast. Have you upped or changed any earnings?
We haven't yet, and it's great to be on. Thank you for having us, Latha. So it was not by design that September 20th. That's a week we do it every year. Okay. But I would argue to that point you made that expectations in India have actually been cut, quite a bit, and quite early in the fiscal year. So normally what you get, typical sell-side behavior, is that earnings are cut towards the second half. When nobody cuts earnings in the first quarter because, there's 9 months to go and we'll wait it out. But because we've got such cautious feedback from corporate India in general, that there's been a significant amount of earnings cuts in the 1 quarter already in the year. And therefore, you're starting off the second half with a very supportive base. And while it's still early days to say how much of an upgrade or if we get upgrades at all, but the base for earnings now looks far more favorable. Whereas on the other side, you've got the support to consumption from the tax cuts in February and these GST cuts which have come through. And of course, remember that the Indian market has got far more interest or far more representation on consumer-facing companies than capex-facing companies.
Yes.
So overall, you are likely to see support to earnings. Expectations being low is a good start for looking at equity.
But has it pushed you overweight on, anything, consumption, discretionary, financials?
We are overweight, India in the EM context, and we are overweight discretionary in India as well. Okay. Right? Because there is a clear shift in policy preference to try and drive the consumer part of the economy a little out of the rut it has been in, let's say, for a few years.
I have lots to ask Sajjid on consumption, but before that, the big event that is just behind us, the Fed rate cut. From an India standpoint and from a global growth standpoint, what are the takeaways?
So a couple of things, Latha. First, the 25 base point cut was no surprise. I think two things I was looking at was that it was important that there was only one dovish dissent, which was Miran. So two governors, as we know previously, voted with the consensus. And that actually is the more important takeaway, that the independence of the Fed is being prioritized more than personal ambition. I think that's an important takeaway.
And that's why the dollar didn't fall further.
Exactly. So you had both, Bowman and Waller, who had previously voted against the consensus, now joining the consensus to say the Fed's very much behind their chairman. The other takeaway for me was that the chairman described this cut as being an insurance cut. And that's not a surprise because we've been arguing for a long time that tariffs and immigration are both stagflationary shocks. They simultaneously hurt growth and push up inflation. So the Fed did this dilemma at this point where the labor market has slowed meaningfully, and the worry is that the US may slip into recession. But at the same time, core inflation is firming and firming and firming. Exactly. So the way we see it is if the labor market were to crack, then the Fed will have a very long easing cycle, no matter where inflation is, because they will presume that a recession is very disinflationary. But if the labor market, if this is a head fake, and the labor market stabilizes, it's important to realize that the break-even rate may be lower in the US now because of all the anti-immigration efforts. Okay. If this is a head fake and the labor market stabilizes, then this could be a much shorter easing cycle because this is purely insurance. Okay. The implication for EMs is not very much. The point is, unlike previous cycles, the dollar has weakened so much in the run-up to the Fed meeting over the last 6 months. That's what matters for EM central banks. So even without the Fed moving, in the last few months in Asia, for example, we've seen a series of cuts across the board. Thailand, Indonesia, Korea, India, the Philippines. So EMs now don't need to wait for the Fed necessarily in the wake of a weaker dollar.
Serious Asian disinflation. And I'll come to that. I tend to get carried away by these topics. But, the one question I would have asked Sajjid, nominal GDP. While the real GDP is very good at 7.8, reminiscent of the 2004 times, at 8.8, does that, impinge on you when you are doing an earnings growth forecast?
It will. And this is something that we've been highlighting to our clients as well. If you roll back, Latha, let's say to FY23, there were several quarters where nominal GDP growth was north of 20%.
Yes.
And when that happens, your 1,000 stocks in the market, the median growth will be high double digits, right? And everything looks great, and you straight line those growth forecasts, you double the multiple, and the market's a multi-bagger. Now, we are single-digit nominal growth, and we will probably stay around the vicinity of 10% for the next 3 years. So we'll have this fallacy of composition in equity earnings forecast, because every analyst will bottom up say, my company can grow 15%, but with the nominal GDP at 9, 10, only a handful of companies will deliver double-digit growth. Right? The median growth of earnings in the market will be a multiple of that 10%, probably a low multiple, right? And therefore, we will have this phenomena where growth from corporate India will get concentrated into the few that can deliver double-digit growth. In our framework, the ones that deliver growth will still command those premiums and will still command the multiples, but investors will need to be careful in assuming that almost everything under the sun will have double-digit growth because it is India.
Oh, absolutely. But Sajjid, what is the inflation trajectory for India itself? Because the GST cut will take away a little bit from prices. But the RBI had forecast 4.9 as 12-month ahead for the second quarter next year.
So inflation is very benign even without factoring in the GST cuts. If you look at the full year as a whole, because each quarter will change. FY26, year ending March 26, our average is 2.8%.
That's the market consensus.
Extremely soft. Now, if you add on to that some fraction of the GST cuts, I mean, the RBI should look to the GST cuts. These are one-time price changes. This isn't disinflation. But you're looking at about, 3%. I think the issue for the RBI is that we've already kind of bottomed out. And if you look forward, base effects have an important role to play. Base effects depressed inflation this year in the middle of the year. Base effects will push up inflation in the first half of the year. First quarter looks above 4%. Second quarter could be close to 5%, but that's coming on a base that was 3% in this year. So you have to average these things out. So I think inflation for the RBI is not the issue right now. I think from the central bank's perspective, I would think that they have front-loaded their easing. They're very focused now on monetary policy transmission. We're seeing good transmission in the banking sector on fresh loans. Bond yields have gone the other way, but financial conditions more generally are easy. And I would say that if the Trump tariff shock persists, my own advice is to take a more surgical approach. This is a sectoral hit on certain sectors. We have an example from COVID before. When there's a sudden demand shutdown, we know what to do. And I think a combination of liquidity support, regulatory forbearance, and targeted fiscal support, I think, will be more efficacious, even as the RBI waits to see how things pan out globally and domestically and holds its any gunpowder
very
for the
quickly,
future.
Rate cut October?
Not in October.
But you expect one more?
Well, I think it'll depend because 30 seconds, Latha, you've got the headwinds of the Trump tariffs, which are very clear, but you've also got some building domestic tailwinds in terms of higher consumption, monetary easing, direct tax cuts, indirect tax cuts, lower inflation, good monsoon. So the RBI and a good, strong GDP print. I think the RBI will wait and see, like the Fed, how is growth panning out? Low inflation allows the RBI to cut in the future, but they'll want to see what the growth trajectory looks like.
Fair point. But, how is the FII interest in your conference? Because we are so clearly the underperformers. Is it reflecting in interest?
Interest is very strong, Latha. And I was worried.
Ulta. Okay.
Ulta. I was worried that given the market's been flat and other parts of EM are actually doing well, that you might see subdued participation this year. This is the 10th conference we're doing consecutively. It's the 80th year for JPMorgan in India as a firm. This is the strongest ever, the largest ever conference we've organized. We have 1,200 participants coming in. We are overwhelmed by the vote of confidence that we've got from our client sets. And again, content-wise, participation-wise, there is absolutely no sign of any waning of interest in Indian equities from both domestics, of course, but even foreign investors.
What are investors waiting for? What are the highlights, if I may ask?
I think let's think of the setup for Indian equities as well. The underperformance has been very stark, especially if you measure it in dollar terms. It's north of 20% YTD. Okay, on multiples, India is now trading at, let's say, a 10% discount to the S&P. Now, we've written research on this quite often to say that India's multiple tends to track S&P more than it tracks EM. So I said earlier, our earnings have already been cut. So expectations have been right-sized to a degree. And we are trading at a 10% discount. And now we've got these domestic catalysts that Sajjid just talked about. So the setup looks great for a bit of a catch-up.
Inflection.
That's right. And what people are waiting for is signs of that inflection. So everybody is here to talk to corporates, to talk to people on the ground, to figure out, are we seeing any now, or are we likely to see any during Diwali or in the December quarter, right? Okay. So to build confidence in what is currently theoretical, but likely to happen, I think that's what's driving everybody to participate.
And you have a lot of corporates representative of consumption.
That's right.
Okay, just a word on financials. Sajjid says at some point in time there can be one more cut, and that's kind of the feeling I'm getting, that no, people are not expecting in October, but they see the space. So does that make financials still something you're worried, not financial so much as banks, because there'll be more margin pressure?
Yes.
Or are you happy that they will be seeing credit growth?
So it's two stories there, Latha. One, of course, is that there will be margin pressure. And the charts are very, very clear. Lower rates do drive NIMs for most large banks down. Okay, it becomes difficult to manage that. However, the hope is that that is the catalyst that drives further lending into the economy. Right? If you do the math on how much it now costs you to buy an entry-level car, right? So you build in the GST cut, and you build in the lower rates, and you look at the delta in the EMI a middle-income family has to pay to buy their first car. That's a very material delta on the loan.
Yes.
Right? And therefore, the argument is that all of these are significant changes and should be a catalyst for volumes. So yes, the margin comes under pressure, but the hope is that over the next 2 or 3 years, for the bank's financials, the volume outlook starts to improve as a consequence of what is happening.
Okay.
And that should therefore be good for the sector.
You know, I spoke to Dixon a few days ago, and they are so bullish on, you know, a 10% fall in the price of a 32-inch plus television, according to them, is going to make a very big difference. But, you know, I have to run into a break. Give me just two numbers. What is your GDP growth for this year, nominal and real?
Yeah, so I think real will be somewhere in 6.5 and 7.
Really?
Because on the back of a nearly 8% first quarter.
Real GDP 6.5
to 7. Nominal could be between 8 and 9. And therefore, it's important for investors, when they look at nominal variables, credit growth, GST collections, tax collections, we have to be realistic. It's not possible to get 13, 14% credit growth if nominal is going to be 8 or 9. That has to be your anchor on which you forecast earnings, credit, taxes, GST collection, which could be high single digits or very low double digits.
Okay, well, actually, even now, although the credit growth is 9.9 or whatever, under 10, if you count the bond market borrowings, then credit to the commercial sector is 13%. So probably we are managing 1.5x credit growth for the kind of nominal GDP. But quick break, I have more questions for you all. We are back. Bazaar viewers, you will get Chartbusters, but we will play the entire show after market hours.